Today's video is going to be another longer form analysis. I believe people enjoyed viewing that, and so I'm just going to go through the analysis step by step as I do it. I haven't done anything yet. I have a few ideas of what I'm looking for, but I haven't actually come to any conclusions. I do want to say that I'm not a professional, I'm just a retail investor, and this is my vlog. If you enjoy watching these videos, please comment below, let me know what you want to see. I am going to be doing an interview here this weekend with a Redditor on a post they made. I believe that that post might have something to do or is related to what Adam Aaron is going to announce on Sunday. Of course, I have no idea. I just like the idea in the Reddit post, so that's coming up. Starting today's analysis with the daily chart, you're going to see it was a green day, a pretty tall green day, with a low of 36.13 and a high of 38.16. The overall range was $2.03. That's pretty good. I want to say that's about the size of the run I was expecting from the diamond bottom that I saw form. If that were true, the close from the previous trading session, 38.89 plus $2 is 40.91. Okay, that is close to the price target I had for the diamond bottom price target. So to see the run, to see that the price moved the direction I thought it would, and even in a comparable height, to see that target not reached is frustrating. Especially because the price was knocked down during pre-market. And on Black Friday, nonetheless. I mean, that just... that's dirty. Okay, well, what do I see? On the daily chart, the RSI is starting to slip and fall, right? I'm going to draw a price level here on the RSI, and I want it to be at that magic number that I like so much, 45. And that level 45, it kind of, I'm going to call it the bear line, just for the ease of reference. At this level, the RSI generally tends to signal momentum is either being lost or gained by the bears. And it depends how the RSI is interacting with that level. I'm going to blow it up a little bit so I can give you a better view. As you can see, when the RSI drops below this level, the price, of course, is in a downtrend, naturally. And when the price succeeds to break out and above this 45 level, that is a bullish reversal, and the price follows. And in the past, it's proven very useful. Let me show you what I mean. We're going to go all the way back to January. Here you can see when the RSI reaches this level, I'm going to put some circles down right there and right there, that the RSI bounces upwards and the price follows with it, and that second bounce off that line is actually kind of what gave us that momentum that caused this rise before that big rip in June, which was super cool. Now, the RSI has been behaving a little bit differently since that run in June. As you can see, it is still interacting with that level. When the RSI falls below 45, it's gravitating back up towards it, and then it drops again, never quite reaching the oversold area, which is 30 and below. I consider that to be pretty bullish, honestly. And you'll see that the RSI swings back up, and it goes above 55. I'm going to go ahead and put that 55 price level down too. And I'm going to name this the bullish line. I'm going to try to do this as quick as I can, and I want to correlate my color scheming as much as possible across all of my charts. So I'm going to make the bearish line cyan and this bullish line purple because that's the way I have it on my 1 minute chart. Okay, and here we go. When the price reaches above this bullish level, which is not 40, whatever that is, it's going to be 55. There we go. When the RSI pushes above that level and maintains it, the price is increasing, all right, and that's because we're seeing bullish momentum taking over. When the price falls through 55 and then below 45, this means that the bears are now in charge, and you can see what happens to the price when we reach that bearish level. So right there, and then all the way through here, the RSI was below 45. And what was happening here was a bottoming action. To see the RSI not reach 30 after passing 45 is bullish because it means that the loss of momentum from the bulls was taken away when by the bears, but then the bears couldn't run with it. The bulls managed to cut off the momentum of the bears, And again, you'll see that the RSI passes above 45, and that's what that is. And here we saw a little peak above 55, but it didn't maintain that level, and we came back down. And this is a great way to watch for those bottoms. And here we have this big fat W in the RSI, and this big fat W here again in the RSI. And there's a similar W back here in the RSI. It's just a curious pattern to watch. The 45 and 55 levels seem to be more informative than the 70 and 30 levels, which is traditional. Bulkowski does promote the revision of studies and indicators to match the particular stock that you're studying, and that makes sense. So what we saw recently was a move above that bullish line and get pulled back down, pop back up, and now it's pushing back down, and it's starting to move back underneath that bear line. So what can we expect from here? Well, the price and the RSI could continue to decline and then bounce out. I mean, I would be shocked to see the RSI fall back down into the 38 or 36 level. That just doesn't make sense at this point. I think crossing into the bear line at all right now is just going to fuel a bounce. I'm looking for RSI just to move up back into this area. What is super curious about today, and I've been talking about this for a while, is the implied volatility. You'll see today it ticked up, and that's because the price hasn't traded in this range for a while, right? Let's take today's range of the candle, and let's just go back. All right, there you go. So the price hasn't been down here for a long time, and that's why the implied volatility went up. And I've been talking about this uptrend that I see and how I want to see it continue. And I've been looking for a more acute spike upward, which we did get today. But again, I would rather it have been at a higher price range, but that's okay. Overall, the implied volatility and the price have a positive correlation. That means that they move together, and when they diverge, or when the one moves more relative to the other, there is generally a correction. And I want to go into that into a little bit, but I need to pause for a second and build a chart. What I have pulled up now is a chart that is comparing the price of AMC, which is in yellow, to the implied volatility, which is in cyan. I'm going to walk through the correlation and what I think is currently happening. I also have the RSI pulled up just for reference. You're going to see that way back here, far left, in December, the price was definitely in a big downtrend. Implied volatility was remaining high and even moving upward. Divergence. You can even begin to see right here at the very beginning the divergence. They're almost mirrored, right? And that's because the price was reaching new lows, and having not traded in that range before, the implied volatility spikes. And you're going to see that the price then rushes upward, and this kind of closes that divergence, and the price starts to correlate. After the peak that we saw in January, I'm going to zoom in. No need to be focusing that hard. You'll see this divergence, right? And I'm going to start using some arrows. Implied volatility went up here and down here. And that continues here as well. And then you're going to see that divergence begin to close. And then from this point on, the implied volatility and the price trend together. So you see the implied volatility and the price spike together, they come down, they spike together, they come down, they come down, they come down, they come down, and then implied volatility drops, and price does not drop. That's kind of a divergence thing. The implied volatility needs to be understood before you can really look for these kinds of patterns. You need to understand that when the price is moving into a range that it's previously been in, that generally decreases the implied volatility, because the price trading in a range over a course of time is a less volatile behavior, obviously. So we are going to see some decrease over time throughout in the implied volatility. And what I want to look at is the trends. The price trends sideways, implied volatility drops, and then look, they correlate again. The trends correlate. They correct itself, and the implied volatility returns to a level. I can't actually see that because I'm actually streaming on my second display. So here we go, I can see it. The implied volatility rises to about 460%, which is about where it was before the divergence started. So the implied volatility here corrected to, realign with the trend in the price, and then both come up together, and then they come down, they go up, and they go down, and they go up, and then there is a little divergence right here as the price moves upward, and the implied volatility moves downward, and then the implied volatility comes up with the price. So there was a little divergence here, the price leading upward and the implied volatility then correcting upward. You're going to see that after that, the correlation becomes more clear. Implied volatility is dropping while the price is grinding sideways here. But again, that's just the reduction in implied volatility because the price is moving within a range. The price is stabilizing. And I don't appreciate that it's doing that. So the price and implied volatility are correlated, grinding sideways with a gradual decline in implied volatility, a little spike, and then boom, the explosion hits. And both things, of course, are correlating. Great. And you're going to see that divergence occur again here as the implied volatility goes down, but the price is moving sideways, and then the price corrects downward. And the two more or less correlate again. Downtrend in the price, downtrend in implied volatility. Here's some divergence right here, alright? Price moving up, implied volatility going down. But again, this is just because of the trading range. And then it gets interesting, because we see a divergence in the implied volatility that's not related to moving within the same trading range, which is at the very, 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 very end. Implied volatility, you see the price is moving down here, but implied volatility is increasing. And we've already seen the price trading within this range. So why is it that implied volatility is going up as price decreases? And that's got to be real volatility entering the stock, and it's probably related to the volume. These price movements with this little volume is not very sustainable, and I can go into that a little bit, and I will. I just wanted to show here that the implied volatility and the price are correlated, and when they diverge, there is a correction in one or the other to bring those two levels back into alignment, trend-wise. So I'm going to go ahead and take away that study just for a minute. Kaboom, and we're going to move back into the price. Again, you see that implied volatility rising as price is decreasing through a price range it's already been in. So the implied volatility is hinting at something, that a big move is coming. And in the past, we have seen that the price will rise to meet implied volatility. And I think that's what's going on. I'm gonna augment my VWAP study really quick, because it's not very useful on a daily chart to look at VWAP on the daily scale, if that makes sense. It is on like the 1 minute chart, you can get more value out of it. Just the visual here isn't very useful. So I'm gonna turn it on to the month average. And you're going to see that the VWAP is way above where we closed today. The VWAP is sitting at $40.72. Again, that's about where the height of the run I was thinking would have brought us to. It's like there's more than one technical indicator pointing that the true price of AMC is above $40. And we've only seen these movements pushing the price below that truly in pre-market. And I mean, we did have one day where the price did drop, but honestly, the candle that followed looked like a reversal, and it was on low volume. So the pre-market this morning was absolutely dirty, especially because volume was comparable to previous days. You can see this. We had 19 million volume, which is still pitiful. But that compares to a lot of other days that we've seen, and it kind of follows our downward trend line as well. Just really quick, I'm going to hop away from AMC so that I can try to get an idea of what volume was like on an index fund. So I'm going to go to SPDR 500 ETF. Here we go. And I don't look at this kind of stuff on my channel very often, but I just want to get an idea of what volume was like. So the volume average here is on 50 automatically. I personally like it on 30, but you're going to see that volume was actually pretty high. Good volume day today on the Spider SPY 500 ETF, and implied volatility ticked up. because it was a big dump. Wow, that's interesting. Interesting. I would love to talk about the SPY. I love looking at this chart. It's so technically just, I think it's beautiful personally. This kind of looks like a giant, okay, I'm not talking about the SPY, but volume was good. So, you know, I guess I'm not surprised to see volume to be comparably high in AMC. I was thinking we were going to see a low volume day, but we didn't. We saw a normal volume day, and that normal volume was a green candle, a tall green candle, which I'm happy with. So let's break it down a little more, get a little more granular, and move into the other charts. But first, I want to talk about this, that the monthly VWAP is like totally flat. It's totally flat, and the price is just bouncing around it. And this looks like the next bounce is due, right? And it's super sketch to me to see that the monthly VWAP is stable like that, with such wide price range around it. That tells me that these price swings are happening on a decreasing amount of volume, i.e. the price is becoming more sensitive to volume every single day. And that's why implied volatility is probably ticking up, because it would take less volume to move the price up every single day. And when it comes to closing short positions, all right, if there's still active shorting and the short interest is rising, that means there are more shares needed to close those positions. And if fewer shares rise the price more, then it works against that works against the short positions. And that's why I'm watching this implied volatilities, because it'll give us the hint about those kinds of things, right? If you're holding an open short position right now and you see this implied volatility ticking up, and you know that downward action is getting just completely rejected over and over and over again, and you realize that there's only so many people that are going to be able to exit that position, the short position, before prices skyrocket, that's going to generate a sense of urgency in the short positions to reach that exit first. And like people running for an exit, there's just going to be this big herd. If the shorts are compelled to cover, or close, I should say close. Shorts can, quote, cover by locating shares. And there's a number of ways that shorts can locate those shares. But honestly, the locate rules are being disregarded, I think, in a lot of ways. It's really common for shares to be sold short into the marketplace, but to not be marked as short. They're just mismarked as long, and then they go into the failure to delivers. And that's a whole nother thing. Really read up on what Dr. Susanne Trimbath has written about failure to delivers. She wrote a book, Naked, Short, and Greedy. I recommend everybody read it. I'm actually going to drop a link in the description of the video, because reading that book blew my mind. I really think Dr. Susanne Trimbath has the best knowledge about the market plumbing and the real story about what is going on with short selling and naked short selling. I think there's a lot of bad information out there, so much bad information. And it's not necessarily incorrect, but maybe it's incomplete, or maybe the bias is too strong. And Dr. Susanne Trimbath, she used to work for the clearinghouse, and she has some insight that others just don't have. She goes into the history with Overstock and what happened to them, and you can see what happened with Overstock's preferred stock in that's tied to a blockchain. That's incredible stuff, and that's why I get so excited about GME and loopering, but I'm not going into that either. I do have a position in GameStop, though. I do. I kind of play AMC and GameStop opposing to each other. When I was getting going, there was a lot of conflict about, hey, GameStop's the one true meme stock, and AMC was kind of vilified as like this distraction play. And I just didn't see it that way. I thought that was really dumb. That narrative doesn't make any sense to me, like, honestly. So I said, you know what? I'm going to do this. I'm going to play GameStop and AMC, and I'm going to trade AMC and just hodl the living hell out of GameStop, and that's what I'm doing. So it doesn't matter which one goes or if there is a distraction, I'm going to be fine, because I'm doing both. And as far as GameStop's concerned, and AMC, I have reoccurring purchases on computer share going. they have fractional shares. Computershare offers fractional share buying. There is a cost, but again, in a dollar cost averaging accumulation strategy, which is what I'm doing with those book entry shares, that's okay. I'm okay with that. It's going to be a long, hard road. I'm going to be trading these stocks forever. I don't care if they moon, Moaz, or drop. I'm going to be trading them. That's it. I'm going to be trading them, and that's what I'm just committed to do. I'm not going to get bucked off of this this horse. So, okay, sorry, a little ranty there. So the VWAP suggests that the price is too low. The implied volatility suggests that the price will rise. And we see that after this gap down today, that the price moved up. That tells me it's time for another run. This dip has been kind of long too. I mean, this dip here was 1, 2, 3, 4, 5, 6, 7, 8 days long. And here we're at 1, 2, 3, 4, 5, 6, 7. So in terms of lengths of dips, it's your 1, 2, 3, 4, 5, 6, 7, 8. And on the ninth day, this one exploded. In terms of dips, this looks like our average dip length is over. And, you know, I gotta start thinking about putting a new chart pattern up, because I think that our ascending triangle target was met today. I still need to calculate that price target, or recalculate that price target, because the trend line in the ascending triangle makes for a moving price target, because typically what you do is you take the height of a pattern and then you multiply it by Bulkowski's percentage mean price target, and that's just an expression of how often this pattern moves relative to its overall height, and it's just a really good statistical average. But on a sloping trend line, if you're subtracting that ratio from the height from the breakout price, the breakout price changes with the slope, so you have to recalculate that breakout, or that price target. So I'm going to be doing that today as well. And so I'm just going to start looking for a pattern on my one-day chart. I'm going to start, this is how I do this, ready? I'm going to start by connecting minor highs and minor lows. That's just where I start. And those are trend lines. There's one. Here's another one. And you can see that the tails of the candles that follow that touch point from the most recent, or the second most recent minor high, are close, and what I'll do is I'll just start to compromise. I'll say, okay, how much of the bodies of these candles can I get? And here I have a touch point on this green candle and this red candle. They're tall candles, I like them. These little candles with high waves or high wicks, you know, I can omit those, and the body of this candle does break above that line, and I remember that was our false breakout. So I have context and reason to draw this line this way, and I'm going to leave that there. And now I'm going to start connecting the minor bottoms. Right, there's one. If I go from here to here, and this can get really sloppy. And typically what you see are a bunch of triangles forming, right? And that's why everyone's drawing triangles. So it's really easy to connect trend lines. But there are other things to be aware of too, like volume trends and you know, false breakouts and such. So yeah, I mean, the price is obviously consolidating. Obviously, it's just getting closer and closer together, volume's decreasing, the price is more sensitive to volume movements. I think this, though, this is big. To see this support here broken through, that's a big deal. And I think to see the price move above this trend line, I think that's important as well. But in terms of patterns, you know, the ascending triangle and the symmetrical triangle I had, those seem to still be the most relevant. I do see a potential downward channel forming right here, but we're missing that fourth touch point, and I don't think that's going to shape out, actually. That's probably not going to happen. So what I'm going to do is I'm going to connect that trend line to this guy right here, and I'm going to say falling wedge. That's what I'm going to say. I'm going to say that's a falling wedge, and I'm okay with that. I really am, because again, this is a double bottom here. There's an uptrend, a downtrend, and then double bottom. Bink, bink, and this is the handle forming, and that's shown on my 4-hour chart. And so I think the best thing to do is just to go to my 4-hour chart and change that the breakout. or change the handle, the shape of the handle. I'm going to turn off after hours trading too. I don't find after hours trading to be very helpful. I'm going to try to not talk under my breath as well. I know it doesn't show up well in the videos. Okay, so busy chart, busy chart, busy chart. Double bottom is shown in yellow, and it's breaking out of this pink descending channel, downward channel, and then the price entered into this consolidation in the form of a symmetrical triangle. This is a handle. The price is waffling up and down, and we did find support at this accumulation zone, and now we see that the price has fallen below that, but it is already starting to jump back up into it, and implied volatility is increasing. That accumulation zone is really important. It's very important. You can see that when the gap formed back in October, that the price struggled to get back above it initially and it fell. But then on the way up, it was no problem. On the way down, again, it provides as support and it bounces, it gets thrown up. And then it was hard to break down through it. So I think the bias here in this accumulation zone is just that. It's bullish. It's bullish accumulation. And when the bears pushed the price below it, of course, it wasn't bullish, but it turns bullish as soon as that bottom is formed. All right, this bottom goes in, the gap fills, and then the price runs, comes down, finds that buying support, and rallies again. Except this time there's another level of resistance that we can't break through. So these two levels, these are the two most important levels to look at right now, between 37.50-ish and 38, and this much more tighter area between 43 and 45. To see the price come down like this does not concern me yet, because again, on the upside, it's going to be easier to go through. I think we're going to cut right through it. In fact, I wouldn't be surprised if on Monday we get that big volume day I've been waiting for, a big volume signal from the bulls. Yeah, this looks nasty. This looks really nasty. But my point here is that this may just change the shape of this consolidation. Maybe it's a downward channel, but probably more likely it's a falling wedge. In fact, I would even give it this. I would call this, maybe this is the falling wedge. The price fails to break out, gets rejected, drops below VWAP, which sucks it back up, throws it back up, but that's too bad. It's going down again, and then we had some support, and then, okay, now we're finding a new low. And this level is important too. You can see that this $36 price target, or this level, has proved to be support in the past, back here. So this is the, I think this might be the floor test that I had been saying may occur. And it's not as low as I thought it would be, which is good, but that has yet to be seen that the bottom here has actually been tested. Yeah, we did have a good bounce. We did have some good volume above the 50-day average, which means it was way above the 30-day average. And implied volatility is ticking up. The RSI is at a level where it typically tends to come back up. Let's have a look at this. Zooming in, pulling this down. What was that? 36? Yeesh. So, and on the 4-hour chart, I wonder if that's not too bad. You know, it looks like back here the price did come down to this level a couple of times, and this is pretty small and it's on the far side of my screen, so I'm going to put some circles down. And after the RSI made those two tests of that level, we did see the big runs up. It doesn't mean that we're going to see that again. It just means that the RSI can recover from this level. Specifically, it can recover from this level. Look at this RSI. It's oscillating very wildly. And the last time it was at this level, the high was around 35.50, the low 34.80. We closed at 35.20. And today we closed at 38.99. So this level in the RSI is proving to be shown at a higher price, which implies strength. It means that the price is generally rising, but again, that's not really something you want to do too much of. It's hard to compare the RSI when it's not leaving or entering the overbought or the oversold region to the price itself. Breaking it down a little more, let's move into the 15-minute chart. This is my busiest chart. This is where I do most of my work, and as you can see, we did have a diamond bottom form here, and it did not play out. And Bulkowski has a couple of things about diamond bottoms that might explain that. I'm just going to go ahead and pull it up, navigate, diamond bottoms. So the measure rule, this is how he comes up with his price targets, and you're going to see on the right hand side you have some examples, some letters A, B, C, and these represent the height of the pattern and then where the price targets go. And so if you read this, he says, see the measure rule, compute the height from the highest peak to the lowest valley in the pattern, multiply it by the above percentage being price target, which is that statistical average of patterns playing out, and then add that to get your target. And I got 40.28 when I did that. He goes on to say that it could be a continuation pattern too, that this happens like a half staff. So in this case, you see the price just continue downward, and you get a similar reduction in height. So let's go to the minor low here and say that that's the height of our dive into the diamond, and then what's our height out of it. And you can see right there, I'll blow this up so it's more clear. As you can see, the diamond actually served as a continuation pattern pretty well, that the price came down to this level and bounced off of it, which is really disappointing. To see this diamond bottom, whoops, play out. No, what was that price level? That was my ascending broadening wedge target. I just deleted it, damn it. That's okay. I know where it is. It's about right here. And it's at this gap level, which is important because that ascending broadening wedge price target was what, was met, and then we saw the continuation here. And so this downward move, I think, is done though. This is done now. The diamond has played out. I'm gonna gray it out, and I'll finish graying it out later. I just gray out patterns that are complete or inactive or don't need to be focused on anymore. But I am gonna keep this price level here still, this 40.28. I have an inkling that this is a fake out, that this dip is totally just an anomaly. I'm gonna zoom in on this a little bit, and you can already see this miniature little flag form, right? And it's not a flag. What? That's not a flag? Cap, how is that not a flag? Everyone and their dog calls everything that looks like that a flag. And I'm gonna tell you why. Because there are actually criteria when identifying chart patterns, and those chart patterns have rules. So let's just look up what a flag looks like. Here's a flag. Volkowski on flags. Okay, here we go. He says flags appear as small rectangles, usually tilted against the prevailing price trend. Alright, those are flags. These are flags in this picture here. And let's go look at his example. He always provides examples. There you go. There you have a flag. It's not a pennant. A pennant is different. Now, a flagpole shows up for the flag and also shows up for the pennant. So let me just scroll up really quick and let's get to that pennant as well. And this video is going to be really long, but I'm just going to assume everyone has a lot of time on their hands right now because holidays! Alright, pennants, here we go. So here now you see that slope, right, in this example to the right, and let's just go all the way down to there, okay? Wow, I would have called that a rising wedge. But he is calling it a pennant. Interesting. And the reason for that is because of the time frame. Anything shorter than I believe it is 3 weeks is not a wedge, it's a pennant. So let's just go through and go see what that time frame is required on a pennant. Let's see here. Chart patterns, index, alphabetize. Let's go to wedges. Sure, wedge falling. Why not falling? Duration. Price trend should touch at least okay, touches, blah, blah, blah. Duration. 3 weeks is the minimum duration for a wedge, or it's a pennant. Whoa! So getting this terminology correct is very important, and I think the community is missing the mark on this time and time and time again. A flag is not a pennant is not a wedge. They are different patterns. The difference between a flag and a pennant is the shape of the consolidation, and their price targets are very, very similar, but they are different. And then the difference between a wedge and a flag and a pennant is the time frame. So here, this actually isn't a wedge. Yeah, I mean, in a colloquial sense, it's like a wedge, right? But it's not. And it's not a flag because there isn't a rectangle shape to this price. And it's not a triangle because, it's got a flagpole. It's just not a good fit to be a triangle. So this is a pennant. And to see the price drop like that during pre-market and then immediately form this bullish pennant, I mean, come on. Come on. This is a pretty clear indication of what's going on in terms of bottoming action. This diamond was supposed to be a bottom. I maintain that. The height in today's price movement and the direction of the price movement matches that diamond bottom. It started too low. If this whole pattern was up nearer to the closing price, or even just at the previous day's low, that price target would have been useful. So I call shenanigans. I don't call shenanigans very often or at all. But honestly, technically, this looks like a total fake out, a total bear trap. And the RSI moving into the oversold region like this and now pulling back up into the, well, it's not quite into the bullish things, but it is in that what I call the coiling zone. And you can see the price here coiling. Now the RSI doesn't coil, but the price tends to coil when the RSI is between 55 and 45. And that's why I have that labeled on my charts as such. And you see the implied volatility did come up, and then it stayed the same. You can see implied volatility does not reflect the move down the price, and that was the hint that the price would return back up. When you have that divergence, right, in the trends between IV and price, there is a correction. And typically when the price drops and IV remains the same or rises, price comes up to meet it. And that is what we saw today, right? We see that the price is lower than it's been, and implied volatility is in an uptrend, and the price is below VWAP. I think the next move is so ready. And whatever Adam Aaron has to announce on Sunday could prove to be a catalyst to launch that run, that rally. Ultimately, we didn't see that $40 strike expire in the money this week. And that's a little frustrating, but it is Black Friday, so understandably, things didn't happen the way that normally they should have. Just the same people aren't around, the volume's different, although the volume was actually above average, right? Like, that's what's crazy too. The price was brought down in pre-market, and then there was a strong presence of bulls. That's just it. The price dropped, boom, bullish pennant. Okay, what now, shorts? You're gonna try to break a bottom followed by a bullish pennant? Like, these are bullish patterns starting to appear in the chart despite the price falling. And other momentum and all the indicators are starting to either reach a level where they reverse, like the RSI, or already showing that a run to correct the price is due. So this is what I see on these charts. I'm not going to calculate this pennant's price target, but once again, I'm going to forecast a run on the next open. That just looks correct. And whether or not the price drops in after hours and pre-market is a whole other thing. You can't foresee these kinds of moves. Only the people who are causing these moves know that these moves are going to happen, right? So that's frustrating. And, you know, okay, just really quick, I saw some news last week, and it was about some strange options activities that a large amount of puts had been purchased, and it really wasn't a lot of puts, like enough to move the price, but the article did imply that it was either an institution or a wealthy investor, but of course you can't see who's placing the trades, just that those trades haven't placed. So to see that happen and the price drop like this, and that, you know, it would take a special level of knowledge to prepare a trade to make money on that, it really gets me going, because Citadel Enterprise Americas LLC has exemptions from the 1940 Investment Act, and those exemptions were granted by the SEC, and you can look that up. Go onto the SEC's website, go to Edgar, and pull up the first filing for Citadel Enterprise Americas LLC. That is Citadel LLC. Now, Citadel LLC is no longer known as Citadel LLC. It's this other company, and that the naming is so different is a part of the confusion. That's another thing where I think the community misses the mark a lot. You know, when we start saying things like Citadel, that actually doesn't help the community, because it puts the real name of that market maker further and further from the truth. We want a clear representation of who is doing what, and then we can start to try to figure out why or what's going to happen next. But I really think that this precision and demand for precision, this is what I would like to see appreciated more in the community. Okay, I'm sorry, I'm just ranting now, right? But maybe some people are into that. I don't know. These are just my thoughts, and maybe it's important that these thoughts make it into my vlog, too. Okay, so here we go. This drives me nuts, because this is just begging. This chart looks like it's begging to explode. I'm going to break it down a little more into the 1 minute. And I'm going to turn on those drawings. Oops. Let's see here, 1 minute. There we go. And, okay, I'm sorry, Paul, that you had to wait so long for your shout out. But, here you are, Paul Rasco. First commenter on, I can't remember when, it must have been Wednesday, right? And Chauvrey was on Tuesday, Full Song was Monday, and you can comment and be first and show up on these 1 minute charts. And as you can see, I keep you up here, so if you would like to hear yourself shouted out during a video, go ahead and leave a comment and say first, and actually be first. Even if you don't say first, sometimes I just, you know, give it to you. Now, what do I see on the 1 minute chart? I see that my VWAP label is totally wrong. And here we go. Is this the monthly VWAP? This is the monthly VWAP. Look how far below the monthly VWAP the price is. Now, this is cool. I didn't draw this triangle. I didn't draw this triangle with the VWAP turned on. And look, the monthly VWAP consolidated, or the price consolidated on the monthly VWAP there and broke down below it, and it's been below it ever since. And there was a distinct drop in implied volatility and a bounce up on this trading day. Really weird stuff. Really weird stuff. I've honestly never seen so much pressure on the price like this before. At least not. I haven't been aware of it. That's what I should say. I haven't been aware of it. I'm sure there has been in the past. It's just I haven't been looking or knew what to look for. And so you're gonna see that gap down from yesterday, and that gap didn't fill, which is so bad. But I'm okay, because again, what did we see? We saw the price go immediately into a consolidation. And that means that in the next trading session, we could see the price break out and above that level and close that gap. Or we're in for another like 8-day dip. But I don't know if that's sustainable. Those dips have been going on for much longer than they should have. And I'm going to go ahead and go into my daily chart now, and I'm going to be looking at those price targets for my symmetrical triangle, and I'm going to reevaluate my ascending triangle price target. As you can see, the monthly VWAP flattens right as the price moves out of my old ascending triangle. And I'm going to go ahead and turn this thing back on, and I'm going to make it blue because this is what color it was when I drew it originally. And I hate it when I misclick and the chart zooms out on me. That's okay. I can just put that down and zoom in again. That was the triangle. And as soon as the VWAP bounced off of that lower trend line and rose, broke out of that triangle, the price just starts doing wild things, right? It's almost like watching someone on like a mechanical bull, right? It's just like, oh my god, what's going on? But the VWAP is stable as get out. Look at that. And that's part of my confusion here, is how long can this go on? How much longer can implied volatility rise and VWAP just stay nearly anchored above this $40 price target? Insane. It's insane. Okay. So the ascending triangle price target, we're going to reevaluate that. I'm going to go over here really quick. I'm going to go to chart patterns, index, scroll down. A for ascending triangle. Here we go. And I'm looking for the percentage mean price target to the downside. So percentage mean price target for up and down breakouts, 44%. So I'm going to take the height of this triangle, and then I'm going to take 44% of that height and apply it to the breakout price, which we now know definitively was somewhere in here. So I'm just going to check my price target. The height of this pattern is 44.44, and I know that because that's the confirmation price for a double bottom line 4-hour chart. I'm going to go ahead and subtract that from the lowest low, which occurred here on this weird doji candle, which proved to be a big reversal, big bounce up. And it's possible we might see something like that on Monday again, where we saw the price break down out of that triangle, and then we had 2 days of like complete indecision before we saw the knock upward. So anyway, I'm going to take that low, which was 34.53. $9.91. I'm going to multiply that by the percentage moving price target for a downward breakout, which is 44. Because the ascending triangle is generally a bullish pattern, and that's why its price target is higher on the upside and lower on the low side. So $4.36. And what was our breakout price at? You know what? I could even zoom in. I want to know more precisely what that price was. Look at that. That was the big Q right there. The price is going down, and that was $40. Really? Really? $40? You can't make that kind of stuff up. You just can't. These technical levels are so relevant. Okay, so I'm going to be subtracting $4.36 from 40. $40 minus $3 and I already forgot how many cents. $4.36. Jeez. $4.36. Oof. $4.36. What do we get? $35.64. Let's see what the price target was. $35.64. Okay. Wow. So how close did we get to that today? Today's low was 36.13. 36.13. So 36 plus 13 is 49, within 50 cents. So, you know, that looks like, I mean, the price could drop down one more time and actually touch that level. But in terms of finding support down here and the low is getting higher, and overall the price is going to go up to correct the VWAP and with implied volatility, I think it's fair to say that the price may have just fallen short of that target. But now this pattern is also complete. Now the ascending triangle is complete. So I'm out of patterns again. I am out of patterns again. And that is kind of nerve-wracking. It puts us into no man's land. I mean, it is possible that this price target being met, filled more or less, doesn't necessarily mean that we won't see the breakout to the ascending triangle. And I don't know though, because this breakout date of the 26th, right? Just a day earlier we saw the breakout there, and then the price target met down here. So the bias was bullish, but what we actually saw was a bearish move against all the indicators, with the exception of RSI. The RSI was the only indicator suggesting that breakdown. But again, at this point, on the daily chart, the RSI is well, it's still ready to fall more. It could still fall more. Like, oh, I hate it, but unless there's a big event, you know, that's kind of what could happen. And that might take a few days to play out. It might take a week or two to play out. But again, like I said, this is unsustainable to see the price moving around VWAP like this and against implied volatility. So overall, that's my analysis right now. We're in no man's land. And that's the best answer I can give. I could draw another triangle, right, from minor low to minor low, like this. But as you can see, that doesn't give us a useful expression of consolidation or anything, because this triangle would overlap these other three triangles. It's just madness. This is just pure madness. There's too much congestion. There is obviously an uptrend that is encountering overhead resistance, but that the ability to resist that overhead resistance has to be diminishing, because the volume, which is correlated positively to the price, is decreasing, and that would mean that the downward pressure is decreasing, and any increase in volume is going to bring a bullish move. What an interesting day today. And I am just beside myself, because this is unsustainable. To see the price bottom like this and then almost double top You know, it's not really a double top because the price isn't technically in an uptrend. I mean, I guess it is from this last low, but now we're seeing another bounce. And it's just a weird look. What is that? Right? I'm gonna go and look on Bulkowski's website for a moment because I kind of have an inkling. I've seen something like that before. I'm gonna go to the pick index on his website and look for anything that may resemble this. Cat's ears is kind of a misnomer. Looking for an M of sorts. Gartley. That could be a bullish Gartley. Tell me, is that what we see? Is that what we see? A, B, C, D? That looks good to me. Let's look for the identification here. Because you can't just look at this and eyeball it and go, yeah, that matches. You actually have to make technical levels and time frames. So he says that this is overall, it's here, it's pretty good. 5 worst out of 5. Oh, it's not very good. Break-even failure rate 40%, average rise 36%, percentage right reversing at point D 90%. Percentage reversing at point D 90%. What's point D? Right where we are now. 90% chance of reversal at where we are right now, and that would correlate with everything I see in the indicators, in the VWAP and even the RSI. Even though it's down, it's at that point where it's ready to turn around. So he says the above numbers are based on more than 1,900 perfect trades. That's what I'm talking about when I say statistical analysis. Bulkowski has used software to identify this pattern 1,900 times, and then he's taken the performance of each of those patterns and then created these other numbers that I'm going to use to try to create a forecast. Now, to identify the Gartley, he says the pattern is complex because it deals with Fibonacci ratios. Oh man, here we go. We're going to get into Fibonacci, so I'm going to go ahead and clear this chart off right away. I'm going to go blank. Let's get, oh wait, I have blank. Yeah, this is what you get for having too many chart drawings. Let's see here. Drawings. Remove drawings. Clear drawing set. Yes. Clean. Okay. Here we go. Try to find it without a computer or calculator is a difficult exercise. Great. The chart pattern can be classified as a variation of a measured move down. The A and C tops look like an ugly double top too. I'm gonna go ahead and start labeling that stuff just because it's just clean. Like I want my presentation here to resemble what Bulkowski has on his website as closely as I can, because the idea is not to trust what I think I see, but to make sure that Bulkowski's analysis actually is being applied. So I'm just going to do the tedious, boring thing and say, boom, there's point A. I'm going to duplicate this drawing, pull it down here. I'm going to call this B. And it's useful to have these here as well, because I may have some numbers or some ratios, some notes that could accompany each of these notes. So, and maybe this will help too if you don't see what I'm talking about. Just make it a little more clear. And being overly, being didactic, over-explaining is good. There is no lack of explaining when you're talking about these sorts of things. Okay, so here we go. Having so many rules makes the pattern somewhat rare. Here are the traditional identification guidelines for the pattern. I mean, the diamond bottom too was something that was similarly difficult, and I think that's kind of, I don't know, maybe that's part of the strategy here, is just to make this chart really, 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 really hard to read. And it is really hard to read. It's so hard to read. It's so easy to misunderstand what these patterns are doing. So, okay, X to A. Price rises from X. See figure on the right, not drawn to scale, to peak A. This is typically a large upward move to accommodate the retraces that follow. Okay. So A to B. Price retraces from the peak A to value B, about 61.8% of the XA move. So here we go. Are you ready for this? Let's see. Where's the bottom? What's this low? This low is 34.58, and this low is 34.53. So this is the true low. I'm going to go ahead and do this. And I'm going to try to get this perfectly vertical. There we go. And I'm also going to make it yellow. Set all curves to be yellow, okay. And I'm looking for 61.8. And gonna make this yellow. I'm gonna set the highs and lows to make sure that we get exact numbers. No eyeballing. No eyeballing. You need to calculate some of these things, and he even says that. So 34.53, so we're gonna change that. And then what was my peak up here? A. This was 45.95. So I'm gonna delete this, and we're gonna go 45.95. Okay, there we go. Oh, and when it comes to the extensions, I turn them on for simplicity's sake. Okay, that's kind of close. We'll see whether or not his example provides some give like that, but we definitely did see that retrace to the 61.8% level at $38.90-ish, and the price turn around. He says after bottoming at B, price climbs to C. The B-C move retraces 61.8% or 78.6% of the AB drop. Okay. So for testing, he says I choose to interpret this as a range of acceptable values. That is my wiggle room, I think, is what he's trying to say. So let's see here. That would be the, I want the inverse of 78.6, right? So he's saying up here. Perfect. Yes. And okay, I got this because a 61.8 or a 78.6 of the AB drop, right? You know, the inverse of 78 is 23, because 100, right? 90, 83, it's pretty close. So I just turned on the 23.6% retracement level, and we see that. And there is a range here that is acceptable. I mean, honestly, this looks really good. The opening price of this red candle here is pretty much exactly at that 61.8% level, and the very peak of this candle is almost exactly at that 23.6% retracement level. So I think that this fits pretty well so far. He says, the final leg of the pattern sees price drop from C to the valley at D. The move is 127% or 161.8% of the BC move. For testing, I choose to interpret this as a range of acceptable values. Okay, so he says that C to D is 127 or 161% of this move. Okay, so this is why he was saying we need a calculator. I can't cheat it on the first one. Yeah, I can't cheat it on the first one, but that's okay. And this one I can't cheat. So we got a high of, let's see here, fuck. I have a hard time, 44.43, 44.43. And we're gonna subtract the low from B, which is 37.50. And you can see how long this takes me, $6.93. And he's saying it's 127% or 161.8% of that move. So I'm going to multiply that by 127, by 1.27. In fact, I'm going to write that down. This is what I do sometimes. Sometimes I just write stuff down. I say $6.93. And so $8.80, that's a big move. That's a big move. Did we have that big of a move? And that was on the low side, right? So the other end of that would be 161 by 1.618, of course. So we're looking for an $8.80 move to an $11.21 move between points C and D. And what did we actually have? Let's get the calculator again. So the high is 44.43 minus the low, which we saw today, 36.13. $8.30. Oh my god, what was the low end? $8.80. So within 50 cents. Within 50 cents. So how much do you bet Monday morning we start with a sell-off and that price dips and it drops 50 cents below today's low? What that would do is it would actually touch the ascending triangle's bottom price target, because remember, it was about 50 cents above that level. So if it drops another 50 cents, it would both complete that target 100% and also complete the formation of this bullish Gartley. And we don't need to see that 50 cent dip. We don't. This is close. You know, there's not going to be any perfect love that fits, or you know what I'm trying to say. I think that this is a good way to look at this strange looking wave, and that okay, I'm gonna turn on my daily drawings really quick. And it starts right here at this bottom. All right, and it's got a couple of touch points, right, with the triangle itself on here. I guess not really. It does. Interesting though. Interesting. I like it. I like this bullish Gartley. So he says if the price drops below X on the way to finding D. Oh shoot! Now I gotta switch my drawings again. What was I on? Blank? Each. If the price drops below X on the way to finding D, what was X? Oh, X. If the beginning. I didn't label that. See what I'm saying? Sometimes you just need to be even more didactic than you think you need to be. I didn't know where X was, and that was a basic point of reference. X. There we go. If the price drops below X on the way to finding D, then the pattern should be ignored. Okay, we didn't see that, so we're good. So what's our measure rule? Once the price turns at D, buy. So if you bought today, Bulkowski would be on your side. He says, that's the problem with trading this pattern. How do you know the stock has completed the turn at D? You just can't. I mean, we have a bunch of indicators suggesting it can turn around, right? He says, for an estimate of the turning price, use the BC move. So B to C move. C to D should be 127% or 162% longer than B, and it is, we found that, okay, but be flexible, which we are. There actually could be a little further downside. Of course, you couldn't dip below X, which was the low of 34.53, and if we had an $11 dip off of the height of C, which was 44, that'd bring us to 33-ish, which would be below this low. So I think that this is complete, because if we saw the 162% ratio between the C to D and B to C runs, then we'd break the pattern. So it's very possible that the lower target, the 127, that's actually where we're at and what we're looking at. Now, when he talks about choosing a stop, he says he chooses a stop, a close below X as a stop location, but once turn D is in place, that could serve as a closer stop. So he's saying that he's going to buy, but he's also going to put a stop down here at X. And what that does is it's going to mitigate his losses should the price continue to dip. And if the price continues to dip before another rip, that would be unlikely. Not very likely. And if it did dip, we have a lot of support down here anyway. So I don't know. The stops are tricky. You gotta be careful with your stops. Now the measure rule. He says after price turns downward at D, the stock climbs to A right here, 45% of the time. That's not very good. To B, 98% of the time. So it almost always bounces up to B, which is pretty low, honestly. What was that? 37.50. And to C, 59% of the time. So 60% chance of seeing that 44.44 number. Jeez. It says the figure shows these hit rates. Okay, so here's his bullish Gartley, and his actually, let's see here, his run up is a 1-2-3 move, and so is ours, 1-2-3. He then has a dip, and he shows a V-type bottom, which we also had here. And then somewhat of a consolidation before a plunge. Oh, but look, his B is further down. So there's a lot of wiggle room here. This is about levels, not about chart pattern shape. This is a Fibonacci study. And you can see that once point D is reached, there is a boom, a big run up near to point C. And you know, that's pretty likely, right? What was he saying? 60% chance? 59% chance of that. And everything I have says the price should be above 40, and point C is above 40. It's adding up. The analysis is still adding up. And then he goes through and he talks about all the retraces and stuff. He says, would you be able to spot this, Gartley, if the labels were not attached? Probably not, right? Probably not. In fact, that I was able to eyeball it is kind of a rarity. Sometimes Bulkowski has these quizzes, and you can go through and try to see if you see him. Feeling crabby? Bearish crab. I don't want to look at that. Oh, he doesn't have any tests. I love it when he has these tests. Okay, so there we go. A bearish bat. Oh, what's that? This just has my curiosity. Oh, that's like the opposite. And it looks like a double bottom, but it's not, I guess. Let's see what his measure rule is for this. Curious. I'll be keeping an eye out for that, but does not draw my attention right now. So that's what I have for today's analysis. We did see this dirty dip in the pre-market, and we did see the move and the run that I thought we would see, just starting at a different price target lower. We did see that although the price was dropped down in pre-market, that a bullish pennant with a little flagpole formed. And I think we're going to be looking good going into Monday. I don't anticipate a dip. I mean, probably if we do see a dip, it'll be pre-market at 50 cents, touch that ascending triangle bottom lower target, and then we're going to see that jump up, probably to that same level C from the Bullish Gartley, and that'll put us above the $40 strike. And I've been waiting for that for so long. I think that this dip, this far away from the VWAP, it's further than the dip we had before, right? Point B is not as far from VWAP as point D is. I think that as implied volatility increases and when the RSI is ready to turn around, that if this corrects up, this move could be the move I've been waiting for weeks. I can't even believe how long this is still being drawn out. But at the end of the day, they're all bullish patterns. Bullish, 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 bullish. And the only price target we saw accomplished on the bearish side from the ascending triangle was actually the less likely result, right? And that dive actually sets us up for a bullish Gartley. So I don't see where the bearish case comes in at all. I don't, especially with the volume exhaustion. And then seeing that volume return today, yeah, it was a half day, but it was a pretty good day. So I'm going to go ahead and get this going. Maybe I take a peek at after hours really quick. I don't typically watch after hours, and today after hours is actually just like on, it's not in after hours, it's, I don't know where it started. Where we start after hours? Probably at right here, where this volume spike was, of course. There's always that volume spike towards close. It's really interesting. Yeah, so let's see. Wow, nothing going on. Nothing going on. Volume is, of course, nothing. RSI doing some weird stuff. It's after hours. I don't watch after hours for this reason, but this was my video today. It was super long. I did go through the analysis process step by step by step by step, and you got to see my thoughts the whole way through. I hope that it was informative and that the music wasn't too loud this time. If you have any comments or questions, please feel free to comment. I am pretty responsive. I am going to link, let's see here. I'm going to link a couple of things down below, and tune in for next time.